Okay, so we're at the fifth week now. Everyone's doing great in the class. I'm very pleased. I'll be grading your last week's work today, right after this class. And good so far. If you have any questions as we come to the last couple of weeks, please let me know. It's very important that you let me know. Okay? At any rate, I'm going to share my screen, and so we can get right into the work. And we're in week 5 now, so it's pretty. This thing goes quickly. So share. All right. So this is the week's work. And in week 5, I'm going to go right to my announcements because I gave you guidance. You want to open up Excel, right? Well, let's look at that first because you're doing a final project for Harbor Roast Cold Brew. Okay, you want to do a final project for Harbor Roast Cold Brew. So when you go to content, and today and this week's keyword will be coffee. Coffee is the key word. So the assessment is essentially going to be, let's watch what this fellow has to say. Give me 1 minute. Sharing for a minute. Fine. Okay, great. So I'm going to share, but I'm going to share with sound this time. Okay, I'm sharing the audio, right? Good. Okay. We'll go back here and let's watch together.
Hi, it's Alex from Ground Up Cafe. Business has been going well, and now I'm ready to launch something new, a line of specialty cold brew coffee. I'm excited about the idea, but before I start selling, I need to make sure it's priced right and that it will actually be profitable. That's where I need your help. For this assignment, you'll first come up with a creative product concept, including a name, description, and even an image. Then you'll take a close look at the costs involved. Everything from ingredients and bottles to rent, labor, and marketing, and classify them as direct or indirect, and as variable, fixed or mixed. Finally, you will calculate how many bottles I need to sell to break even and what that means for my overall revenue goals. In a short memo, you'll also explain your results and what they mean for the cafe's financial planning. With your help, I'll know whether this cold brew launch is just a fun idea or a profitable new product for Ground Up Cafe.
Okay. So he wants to come up. You have to come up with
Hi, it's Alex.
hold on a minute. I'm not so worried about the actual name. You can put that on, but you'll continue your role as an accounting advisor to Alex, the owner of Ground Up Cafe. He's preparing to launch a new line of specialty cold brews. Then you're going to open up this template. So let's take a look at the template together. So you're going to have the cold brew ingredients. You're going to have the new refrigerator lease. That's a direct cost. You're going to have the branded bottles per unit. You're going to have the rent. That would be a fixed cost. The part-time barista, electricity, social media marketing campaign. And then you have to break it up between fixed, variable, and what the break even is. And once you know your break even, then you can figure out your break even in units, right? Because what happens is whatever's fixed, whatever is your fixed expense, whatever you calculate as your fixed expense, you have to sell enough coffee or enough of these cold brews at $1 to cover those expenses. Once that happens, then everything you make afterwards is a profit over your variable cost. Over your variable cost. So let's take a look at different types of cost. Let's take a look at it. Again, coffee is the key word. All right. So what are the variables? So try to think of it that way. Think of it this way as an example. If I'm running a pizzeria and I'm selling pizza at $20 a pizza, every pizza I sell is $20. And I have $10,000 worth of fixed costs. In other words, the cost that I'm going to make, whether I sell a pizza or not, well, then I have to sell at least at $20 and $10,000 a month is my fixed cost. I have to sell at least 500 pizzas. Now I've covered my fixed costs, which I'm going to have to pay no matter what I do. Then if I calculate the cost of making the pizza, like the dough and the sauce and everything else, and let's assume that cost is $5. I'm selling for 20. Then every pizza afterwards, my contribution is $15. And that's where my profit is. So my break even would be 500 pizzas. And then everything I sell afterwards would be my variable costs, and that I would make $15 a pie. So direct costs are directly related to the production of the product and could be traced back. So that could be raw materials, like in my case, sauce or dough and that sort of thing, cheese. And then indirect costs, which are associated with specific time rather than the production of goods. They include expenses like selling and administrative costs. And unlike product costs, which are capitalized and then expensed when the products are sold, period costs are expensed as they occur. So in other words, the original costs, like building building out my pizzeria, buying chairs and tables and all that stuff, I could put that as an asset and capitalize it, meaning I could write it down. That's what that word basically means. But then everything else afterwards is going to be a variable cost. And so I have to, as a business owner, or certainly as a business owner's financial advisor, I have to be able to look at the difference between what costs are fixed, right? What costs are fixed and what costs are variable. Because this way I know what I have to cover to break even. And then the second thing is, how much money do I make with each unit that I sell, right? So that's how we fix that. Period costs are associated with a specific time rather than the production of goods, selling and administration. Unlike the product costs, which are capitalized, the other ones are expensed when they occur. So if we have direct materials, right, and direct labor that go right into our product, then indirect materials and labor used in small amounts or across multiple products include fixed costs allocated to the product. And period costs are costs associated with general operations. So the period costs are like law, legal, regulatory, that sort of thing. Overhead might be stuff that we bought, like for instance, the lease on the oven for my pizzeria, or in Alex's case, the lease on the roasters. And that gets allocated to whatever I'm doing. In other words, I think about how much I'm using for each product and I allocate, right? If I bought a computer system at a supermarket, I might want to allocate the cost of that computer system among the different departments that are using it based on their revenue. Say, for instance, some to produce, some to frozen foods, some to meat, that sort of thing. Direct labor is a product cost and direct materials are product cost. So that's the difference, right? And these are your examples. So a direct cost would be the phone case, the phone screen, the electronic components. The labor cost would be the people putting it together. The overhead would be adhesive, sealants, things that I buy and have to keep in inventory and I will allocate. And finally, sales and market development, general office is going to be my period cost. So variable costs, and you really need to understand this, variable costs are the costs that change with every unit of production. So in the case of a pizzeria, it's the boxes, the cheese, the sauce. That would be a variable cost. So a fixed cost would be the rent and the salaries, whatever it's costing me for the rent and salaries, and they stay the same regardless of the level of production. However, the fixed cost per unit goes down as production increases, okay? Mixed costs have both fixed and variable cost components. So an electric bill, because it has a monthly delivery, could be something could be fixed and some could be varied, but depending on how much pizza I'm making. Let's say I got an electric oven. Well, of course, it's going to go up when I'm making pizza, so I have to be able to allocate that. That's a little trickier for most people because fixed and variable are pretty easy to just understand. The mixed ones, you have to have an accountant go in using accounting principles and allocate them. So when activity increases, variable cost increases. When activity increases, variable cost decreases. When activity increases, variable cost per unit should stay the same. Because even if it goes up, it shouldn't change your variable cost. They should stay the same for each pizza. And the same thing, they should just always stay the same. Fixed costs should remain also constant when it increases and also remain, because those things are fixed. And fixed cost a unit should go down because as you're producing more, so if I'm not producing anything, I've got that. Remember, go back to my pizza example. I've got that $10,000 cost. But as I keep producing, right? So when I sell the first pizza, the fixed cost to allocate the first pizza would be $10,000, a lot of money. But when I sell the 10,000 pizza that month, my fixed cost goes down to $1. And that's the secret behind revenue growth. The more I grow,
The
the more I
break-even
knock
point
down
is
my
the
fixed
point where
cost.
sales revenue covers both the
So,
variable and fixed costs.
so if you
There is
want
no
to think about
profit
it,
and no loss.
come on.
The break-even point is always the starting point for cost analysis.
Hold on one second. So you want to think about it this way. What's the magic behind, say, Home Depot or McDonald's or Starbucks? They've come up with these recipes and these method of operations years ago, and it costs them money to do that. And that's a fixed cost. But the bottom line is they sell more and more Big Macs and more coffee or lattes or whatever they sell, or any more of these things, or in Home Depot, as they sell more product, those fixed costs keep going down. And that's called economies of scale. And what economies of scale do for us is they allow us to keep lowering our fixed costs as we produce more product. Okay? So you got to be able to, so this is an important chapter. We should got to be able to differentiate between these costs. So let's take a look now.
The break-even point is the point where sales revenue covers both the variable and fixed costs. There is no profit and no loss. The break-even point is always the starting point for cost analysis. Businesses need to know the critical cutoff point before losses are incurred. The break-even point is the calculation often required in business plans and business proposals. Investors want to know if the break-even point for a proposed business is logical and reasonable. If a business is going to struggle to reach the break-even point, the probability of the business making a profit is going to be an even larger challenge. Let's examine the basic steps for determining break-even using Stacks and Bytes Cafe. Examine the table on this screen to learn more about the break-even in units and in sales revenue.
So this is your fixed cost and your total fixed cost. This is how much you have to sell enough product to cover those fixed costs. Then once you do that, then everything above your variable cost is a profit.
Examine the table on this screen to learn more about determining a profit using the break-even formula.
So you got 50,000 in fixed divided by $40,000 profit. So $5 a unit is your contribution margin, right? $5 per unit is your contribution margin because you've already covered your costs. So 18,000 sandwiches annually for a $40,000 profit. Okay, rounded up. So everything above your fixed cost, you're going to get a contribution level, which is your amount that you're making above your variable cost. So 18,000 sandwiches times $10 a unit is $180,000 in annual sales. If I take 180,000 annual sales, divide less my fixed cost and less my variable per unit, because remember, every time I sell a sandwich, it's costing me money. 18 times 5 is 90. There's my profit. But very important you understand that. Okay, and that's really what I've been repeating But that's how you do this problem. Now, stay with me. Let me see something else. Do something else for you. Okay. That's not it. Account. Okay. Bear with me. See something. Let's see. I think we're okay right now. But let me see what. Right. Hold on. Oops. Stay with me one moment. Okay, we have one more week to go, by the way, before I show you my guidance. We have one more week to go on this thing. So this class ends. Let's look at our calendar. This class ends at approximately stay on the same page for everybody. Yeah, it's not going. So the last day of class should be the 20th. And today is the 10th. So we'll try to get one more in next week, okay? Now, let's take a look at my guidance. So the guidance, you go to my announcements, and you look at the week 4 guidance, and the keyword is coffee. Once again, keyword coffee. Use my guidance. So you got a Harbor Rose view. That's you're going to put that's in your product tab. Course number 1, you take your direct, your indirect, and your period cost. And course type number 2 is variable, fixed, and mixed. And you mapped it as follows. The cold brewed ingredients per cup is direct and variable. The branded bottles per unit is direct and variable. You knew your refrigerator lease is indirect, but fixed, because you got to pay that every month, right? So the first two are direct, but they're variable. You include them in variable costs. The new refrigerator lease would be indirect, but it's fixed, because it's not directly related, but you have to pay for it to keep the business going. Your cafe rent would be indirect, but also fixed. Your part-time barista, a new hire, would be direct because that person is making the brew, but fixed, right? Because you got to pay them whether you sell coffee or not. See how it goes? The electricity is indirect, but mixed. And the social media marketing is period, but fixed. Disposable cups are also period, but variable. See, social media market is period because we're going to pay for it from period to period, but it's fixed because let's face it, I got to pay no matter. I'm going to pay it whether I sell or not. The electricity, I have to mix it up because some might be like I just have to keep the doors open, and some is going to go up when I produce more goods. So your selling price per unit is $4. Your variable cost is $175. Your fixed cost per month is $3,600. Your contribution margin would be $4 minus $1.75. It's 2 1/4. So your break even is going to be $1,600, 1,600 bottles. Because if I take 3,600 divided by $4, right? I know what my fixed costs are now. If I take 3,600 divided by $4, hold on 1 second. If I sell 1,600, if I sell 1,600 bottles, okay, I would cover all my fixed and any kind of, so yeah, if I could sell 600 bottles, hold on. Stay with me. Divided by 2 1/4, because don't forget, every time I sell something, I got to allocate $1.75 to variable. So my contribution margin will be 2 1/4. If I take my fixed cost divided by 2 1/4, I have to sell $1,600 to break even. Okay, or my revenue would have to be $4 times 1,600, would be 6,400. So I got to either make 60. So once my revenue number hits 6,400, then I've broken even. But I need 1,600 bottles to cover the 3,600 less my contribution margin. Note that includes electricity. Is mixed, but treated as fixed here for planning. You can do that in this problem. You can treat it as fixed, okay? You could treat it as fixed. Swap the placeholder image with your AI rendered bottle shots, or put something in there that looks pretty. That should be fun. That shouldn't be hard. And if the barista will be hourly and scale with volume, move part of that cost to the variable, and the spreadsheet will update the break even automatically. If you negotiate bottle of bean discounts, update those units if you did that. I wouldn't worry too much about it. Try to make this as clean as possible. And finally, remember your fixed cost divided by your price minus your variable cost would be your break even, okay? So hopefully there are no questions on this, but I want to go over something else. I want to show you a little bit. So that should give you everything you need to do this, but if you need any more help, you just contact me. So let's take a look at this.
Knowing the costs involved in running a business is extremely important, as it can be the difference between your business making a profit or a loss. In this video, we'll go through fixed and variable costs and how to calculate total costs. Costs are the expenses incurred by a business when making a product or providing a service. Common costs a business has to deal with are rent, salaries, raw materials, and electricity. These costs can be split into two separate categories: variable costs and fixed costs. Let's start with variable costs. Variable costs are called that because they vary with the level of output from the business. This means the more products the business makes, the higher the variable costs are. For example, raw materials such as cotton in the creation of a t-shirt would be a variable cost. This is because the more t-shirts that are made, the more cotton is needed to produce those t-shirts, which increases the cost to the business. Basically, as the level of output, so the number of t-shirts the business makes, increases, so does the cost. Therefore, this is a variable cost. Let's have a look at an example of variable costs in action. Tom's Tops is a t-shirt business. Tom's variable costs, such as his raw materials, electricity, and packaging, are £5 per unit, or per t-shirt. So, for every one t-shirt that Tom's Tops produces, it costs him £5 in variable costs. However, that's just for one t-shirt. He wouldn't have much of a business if he only produced one t-shirt. So, we need to find out Tom's total variable costs. Total variable costs is not just the cost of one t-shirt, it's the cost of all the t-shirts that Tom produces. In this scenario, Tom can make 500 t-shirts a month. To calculate Tom's total variable cost, you multiply the variable cost per unit, so per t-shirt, by the level of output. In this scenario, that's £5 per unit times 500 units produced. That's his level of output. This means that Tom's total variable costs for the month are 5 times 500, which equals 2,500. Tom also has other costs, such as rent, salaries, and insurance to pay. These are known as fixed costs. Let's have a look at fixed costs. Fixed costs are called this because they stay the same and do not change with the level of output, unlike variable costs. The rent on a warehouse stays the same whether the business produces 2 or 2 million t-shirts. The rent is set at a specific price and doesn't fluctuate with the amount of products created. Let's add Tom's fixed cost to the mix. The first fixed cost Tom has is rent of a small storage unit. This is £500. It takes a monthly salary from the business of £1,200 and has insurances of £200. In order to get Tom's total fixed cost for the month, you add all these together. This gives Tom monthly total fixed costs of £1,900. So whether Tom makes 0 t-shirts or 1 million t-shirts, all the above costs stay exactly the same. So now we know Tom's total variable cost for the month, and we know his total fixed cost for the month. This is where we can calculate his total costs for the business. This is calculated as total variable costs plus total fixed costs equals total cost. So let's have a look what this looks like for Tom's business. Tom had total variable costs of £2,500. He had total fixed costs, such as rent, salary and insurance, of £1,900. 2,500 plus 1,900 equals 4,400. This means that for this month we've looked at, Tom's total costs are £4,400. Knowing total costs is really important because it allows the business to make informed decisions. For example, Tom can make 500 t-shirts a month and he's got total costs of 4,400. So in order for him to break even, he needs to at least sell £4,400 worth of t-shirts that month. If he sold each t-shirt for £10, he'd have revenue of £5,000. This would cover his costs of 4,400, meaning he's making around £600 profit. If he didn't know his total costs, he might decide to sell his t-shirts for £5, which would mean he'd then only make £2,500 a month and he'd be making a loss. So knowing his total costs allows him to understand his business better. It can help him set a price that's going to make him profitable. In this video, we've gone through variable costs, fixed costs, and how to calculate total costs. If you want to understand how to calculate the revenue of a business, then watch this video here, which is a step-by-step guide on how to calculate revenue. Thanks for watching the video to the end. Don't forget to hit the like button and subscribe to the channel for more weekly business videos.
Okay, so that wraps it up today. Use the guidance that I gave you. Don't worry so much. If you can't like totally knock out the next course, I'll accept that. If you want to allocate, I'll accept that. If you want to allocate the barista, I'll accept that. You can go either way and use, your ability as an accountant. And just, work it out that way. But I'll give you credit either way. Really what I'm looking for is that you understand the total concepts. That's the most important thing. Okay, so that's it for today. We're coming down to one week. You guys have been great. Keep doing what you're doing. I'll grade your last assignments promptly, and I'll see you one more time. And I'll set this up. I'll be sending this out while you're watching the YouTube. So coffee is the keyword.